Subsection 5 of the Reference Guide to Regulatory Compliance includes securities, insurance, and other financial services. And the first chapter within subsection 8, not 5, is Consumer Protection and Sales of Insurance. In November of 1999, the Gramm-Leach-Bliley Act became law. Part of this law was entitled Insurance Customer Protections. This portion of the law required the federal banking agencies to issue consumer protection regulations that govern retail sales, solicitations, advertising, or offers of insurance products, including annuities by depository institutions or third parties that are engaged in insurance sales at the bank's office. Specifically, the regulations cover sales practices, disclosures, and advertising, the physical separation of banking and non-banking activities, and domestic violence discrimination. Regulations were issued in early 2001 with an October 1st of 2001 effective date. On August 17th of 2001, the banking regulatory agencies issued an interagency response to questions posed by the ABA and the American Bankers Insurance Association on the implementation of these regulations. Coverage applies to the following activities as they relate to insurance or annuities sold or offered to consumers. That's retail sales practices, solicitations, advertising, and offers. Persons covered by the regulation include all banks, any person engaged in covered activities in an office of the bank or on behalf of the bank, any person representing to consumers that the sale, solicitation, advertisement, or offer of insurance is by or on behalf of the bank, persons with whom the bank has a contractual arrangement to receive commissions or fees from sales of insurance, and to whom the bank refers customers, and lastly, persons who sell, solicit, or offer insurance with documentation that refers to or identifies the bank. Exclusions. Forced place insurance is not covered by the regulation. Private mortgage insurance is not covered as long as the financial institution purchases the insurance for its own protection and merely passes the payment along to the consumer. Insurance sold for purposes other than personal, family, or household purposes is not covered. So those are all exclusions. Prohibited practices at the top of page 954, A, B, and C. A lender may not lead a consumer to believe that a loan is conditioned on either the purchase of insurance or an annuity from the bank or an affiliate, or 2, an agreement by the consumer not to obtain insurance or an annuity from an unaffiliated entity. B, the bank may not engage in any practice or use any advertisement at any office of or on behalf of the bank that could mislead a consumer to believe that the 1, insurance is backed by the FDIC, the federal government, or the bank. 2, there is no investment risk, if applicable, including the potential loss of principal. 3, a loan at the bank is conditioned on the purpose of an insurance product, or 4, the consumer is not free to purchase the insurance product from another source. C, domestic violence discrimination. If being a victim of domestic violence or a provider of services to victims of domestic violence is considered as a criterion in any decision with regard to underwriting, pricing, renewal, or scope of coverage of the insurance, the bank may not offer any life or health insurance product for sale as principal agent or broker. Disclosures, content, 1 and 2. 1, insurance or annuity disclosures, and 2 are credit disclosures. Under number 1, for insurance and annuity disclosures, the bank must disclose the following with the initial purchase: that A, the insurance or annuity is not a deposit or obligation of the bank, nor is it guaranteed by the bank or an affiliate of the bank. B, the insurance or annuity is not insured by the FDIC or other government agency or by the bank or its affiliates. And C, there is investment risk, if applicable, associated with the product, including the possible loss of value. For credit disclosures, the bank must disclose the following in connection with an application for credit with which an insurance or annuity product is solicited, offered, or sold. And A, the bank may not condition the credit on the consumer's purchase of the insurance or annuity from the bank or any of its affiliates, and B, the bank may not condition the credit on the consumer's agreement not to obtain the insurance or annuity from an unaffiliated entity. Timing of disclosures, 1 and 2. 1, insurance disclosures must be provided before the completion of the initial sale of the insurance product or annuity to the consumer. And 2, the credit disclosures must be provided at the time the consumer applies for the credit. C, delivery. All required disclosures must be provided orally or in writing. Mail applications, telephone applications, and electronic disclosures. 1. Under mail applications, no oral disclosures are required. Under telephone applications, the bank has 3 business days to deliver the disclosures beginning on the first business day after the sale, excluding Sundays and federal holidays. And for electronic disclosures, the bank may provide the written disclosures electronically if the institution complies with the e-sign, and if the consumer affirmatively consents to the electronic disclosures. The disclosures are provided in a format that the consumer can retain or obtain later. And for electronic disclosures, lastly, if they are provided electronically, no oral disclosures are required. D, disclosures must be conspicuous, simple, direct, readily understandable, and designed to call attention to the nature and significance of the information provided. B, meaningful, and examples of methods that call attention to the disclosures include plain language, wide margins, easy to read, typeface, and so forth. Disclosures must not merely state that the required disclosures are available in printed form without also orally disclosing the information, or allow a consumer to bypass the disclosures when they are given electronically. Acknowledgement and renewals are the last parts under disclosures. For acknowledgement, the consumer must acknowledge the required disclosures in writing, either electronically or in a paper format at the time the disclosure is received or the initial purchase is made. In a telephone transaction, the bank must obtain a verbal acknowledgement from the consumer and make reasonable efforts to obtain one in writing. 3. The bank must retain sufficient documentation of an oral acknowledgement. And G, renewals. If the customer received disclosures at the time of the initial sale, disclosures do not have to be given at the time the policy is renewed, provided the renewal does not involve a different type of insurance. Advertising requirements, Part 4. The following disclosures are required in all advertisements for insurance products and or annuities. And this includes, I believe, 5 things that are going to be very repetitive. That this is not a deposit, this is not FDIC insured, not insured by any federal government agency, not guaranteed by the bank, and lastly, may go down in value. Location of insurance activities, A, B, and C, in Section 5. The area where the insurance or annuities products are sold should be physically segregated to the extent practicable from areas where retail deposits are routinely accepted from the general public. B, the bank should distinguish the insurance product or annuity sales area and clearly delineate it from the deposit-taking areas. And C, bank personnel who work in areas where deposits are routinely accepted may refer a consumer who seeks to purchase an insurance or annuity product to a qualified salesperson only if the person making the referral receives no more than one time nominal fixed dollar amount for the referral. The referral fee cannot depend on whether the referral results in a sale. Qualifications. Part 6. Persons selling insurance products or annuities as bank employees or on behalf of the bank must be appropriately qualified and licensed under applicable state insurance licensing standards. The FIRA liability is about what you would expect from reading other regulations, $7,500 per day for violations of laws, $37,500 per day for unsafe or unsound practices, or engaged in recklessly or part of a pattern of misconduct that causes more than a minimal loss to the bank or a pecuniary gain to the parties involved, and then $1.375 million per day against persons who knowingly commit a violation and knowingly or recklessly cause a substantial loss to the bank or a substantial benefit to the party. There's some practical applications here of a sample insurance notice and an insurance credit disclosure. I suppose since there's time I'll read them. The disclosure must be provided to all potential purchasers of an insurance product. And this disclosure reads, our insurance products and annuities are not a deposit or other obligation of or guaranteed by the bank or any affiliate of the bank. Our insurance products and annuities are not insured by the Federal Deposit Insurance Corp. or any other agency of the United States, the bank, or an affiliate of the bank, and in the case of our annuities, there is investment risk with the product, including the possible loss of value. For the insurance credit disclosure, this shall be required when a borrower purchases insurance in connection with a credit transaction. The following applies to the credit insurance product you are purchasing in connection with your loan. The bank may not condition as an extension of credit on either 1, your purchase of the credit insurance product from the bank or any of its affiliates, or 2, your agreement not to obtain, or a prohibition preventing you from obtaining an insurance product or annuity from an unaffiliated entity.